Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of Eneti Inc., ticker symbol NITI, NETI. At the time of recording this video, Eneti is trading for $6.69 per share. Year to date, their stock is down just about 13.5%. Over the past year, their stock price has fallen by 2/3. Going back 5 years, their stock price is down 90%. Which is a negative 37% compounded annually. And since they were publicly listed, Eneti has lost 99.4% of its stock value. At one point, this business was trading for over $1,000 per share. Now it's down to just under $7. So Eneti is trading near its 52-week low, down quite a bit from its 52-week high. The business is a $266 million market cap company, so a smaller business than what we've typically looked at. So what does Eneti do? Eneti Inc. engages in the offshore wind and marine-based renewable energy businesses. It owns and operates 5 wind turbine installation vessels. The company was formerly known as Scorpio Bulkers Inc. and changed its name to Eneti Inc. in February of 2021. Eneti Inc. was incorporated in 2013 and is based in Monaco. So this business has undergone both a name change as well as a underlying business transformation. They used to be a shipping company. I'm not sure what happened to those shipping assets, whether that's another part of Scorpio, but now all Eneti does is provide vessels for these offshore turbine windmill installations. We'll be performing a modified 8-pillar analysis of Eneti, taking a look at 8 different financial metrics to come to a holistic beginning understanding of the business just by looking at its financials. So that method was popularized by Everything Money, and let's get right into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. We also want it positive, meaning that the business produces money. Currently, they have a negative PE, and over this time frame, they've also had a negative PE. So that's an X to start off. Pillar number 2, we want their average 5-year return on capital to be above 9%. Currently, they have a negative return on capital. They've only had positive returns on capital in 2 out of these 5 years. Averaged out, it's negative. So again, that's another X on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Eneti has not grown revenues. Their revenues have declined by about $18 million. This might be as a result of their business change, but I'm not sure without doing a deeper due diligence into the business. Nevertheless, pillar number 3 is also an X to start off. So far, we're not starting off so hot. We're 0 for 3 on our first 3 pillars. Pillar number 4, we're looking for 5-year net income growth. This one's going to be a check. They had negative net incomes in 3 out of these 5 years, including in 2017. Last year, they produced positive net income with $20 million of earnings. So that's going to be our first check on pillar number 4. Pillar number 5, we're looking for them to be decreasing their shares outstanding. In 2017, they had 7.2 million shares outstanding, and that increased to 16.3 million in 2021. So this is over a 50% dilution for existing shareholders. This is not a good sign. When you purchase a share of stock, what you're really buying is a fractional ownership percentage of the underlying business. When a business dilutes existing shareholders, it ultimately lowers your ownership percentage of the business and the percentage of the business's profits that you're entitled to. So this is not a good sign here. So this can be a silent killer for investors and is not a good sign here. That's an X on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. So technically, they have decreased their free cash flow loss here. They had a negative cash flow of $200 million in 2017, and they had negative $28 million of cash flow in 2021. So free cash flow is cash from operations minus capital expenditures. It's really the lifeblood of any business and can be used to pay down debt, pay dividends, buy back shares, reinvest back into the business, or make acquisitions. So even though it has become less negative over time, it's still been all over the place, and their cash from operations has actually decreased. So while this is technically a check on pillar number 6, take it with a grain of salt. Averaged out over this time period, Eneti burns about $52 million of free cash flow each year. Pillar number 7, we want their net debt, which is long and short-term debts minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So at the end of 2021, Eneti had negative net debt, meaning that they actually had $11 million in cash and equivalents on their balance sheet after subtracting all their liabilities. However, we can see that year to date, they've actually re-added debt to their balance sheet. Now they have $33 million of net debt. Either way, based on the fact that they were burning about $52 million of cash each year, pillar number 7 is going to be an X. They don't have enough cash and equivalents on their balance sheet to support this level of cash burn going forward into the future. So something's got to change for this company in order for it to be sustainable. That's an X on pillar number 7. Finally, the big pillar of them all, pillar number 8, we want their market cap, which is $266 million at the time of recording this video, to be below their average 5-year free cash flow multiplied by 20. So they had a negative average free cash flow, which means that pillar number 8 is going to be an X. Ultimately, the value of any productive asset is rationally going to be based on its ability to produce cash flows into the future, discounted back by a reasonable interest rate. Because they actually burn cash and that they don't have these positive cash flows, this business does not have any margin of safety for us. Lastly, we're going to take a look at its dividend profile. So one mistake that investors make a lot is blindly chasing dividend yield. So if a dividend is part of our consideration of investing into a business, we want to understand whether it's supported and whether the dividend is healthy or not. By comparing the dividends that they're paying out versus their cash flows, they've had to decrease their dividend over time. They've only had enough cash flow to support their dividend in 1 year in 2018. And since then, they've been burning a ton of cash and still paying out a dividend. So this is not a financially sound picture at all. It would be more advantageous for them to not pay dividends based on the cash that they're burning. Their dividend yield is not supported by the cash flows that this business actually produces. So in summary, Eneti checks the box on 2 out of 8 pillars. They have negative free cash flow and they don't have enough cash on their balance sheet to support the business without raising more money in a way that's probably disadvantageous for them at this point. They're also paying out dividends when really they shouldn't be because they don't have enough cash and they don't have the ability to produce cash flows in order to support those dividends. So this is not a pretty picture and their fundamental financials are in pretty rough shape. So this type of analysis is just a starting point. Please don't use it as any sort of financial recommendation to buy or sell. This is not what that is. This is just getting a holistic beginning understanding of the business. If you're interested in learning more about Eneti, I highly recommend that you dig into the company's filings and understand exactly what's going on behind the scenes before considering any sort of investment. That's it for today's video analyzing Eneti Inc., ticker symbol NETI. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Eneti with me, and have a great day.